Joining us now to talk all economics is JMP Securities President Mark Lehmann. And Mark, it's good to see you this morning. Thanks so much for joining us.
Morning, Maria.
Your thoughts on the backdrop for investing right now, earnings and this upcoming jobs report. What do you expect?
Well, the market's been dominated by news, not by earnings, as October has progressed. And obviously, last week was not a great week for the markets, and October's been an awful month. I think we're seeing the futures point a little higher. I think that, the VIX trending as high as it has. I think we've seen the highs of the year and the lows of the year so far, and I think we're going to recover a little bit here going into the election and going into the fourth quarter.
So more volatility is what you're expecting.
I think volatility is going to reign supreme. I think we've had a headline-driven market to date. I think investors, for the first time in a while, are not reacting to some good numbers, and that tells me something. We're seeing IPO pricing denigrate, go down a little bit here. We've seen some deals that have been cut in half in size, and the deals are not really popping anymore. We've seen some deals break price. SurveyMonkey, which was a high-profile IPO of the third quarter, broke price and is trading below their IPO price. Those are warning signs that'll tell you we'll see a little bit of a tempering of the markets, but I'm not worried about the market going into 19. I think better days are still ahead.
Mark, the market shook off so much news all year. Every day there was something in the news cycle. And the news cycle in the month of October, if you look at it versus the rest of the year, isn't that much different. But why is it that anything going on right now, the market's almost gone hyperbolic in terms of how they react to it?
I think you said it well. I think we shook off a lot of bad news, and I think we shook off a lot of fear. Let's use the China tensions that we've seen through the year, and that continues to be in our backdrop. And I think nobody expects that to end quickly. And I think the specter of more tariffs and of more back and forth is in front of us. I think there's also a question about the tax cuts and the results on earnings, what that means for comparisons going into 19. We have great comparisons, 18 over 17. What are the comparisons looking at 19? And I just think more and more of that has grown into the market specter, and that specter now is a little bit more cautious.
You have a major overreaction by investors to a little sliver of bad news. We've been talking about sales missing expectations for revenue missing expectations for weeks now. But if you looked at Amazon, and the Wall Street Journal points this out today, that on Thursday evening it posted a record, a firm with a record third quarter profit, right? It was 11 times more, the profit was, than the period a year earlier, but its sales came up a little bit short of expectations. There were concerns about the forecast for the holiday season, but its shares fell almost 8% on Friday, and the S&P was only down 1.7%. Amazon stock is down 18% so far in the month of October. That seems like an overreaction.
But isn't it up big since?
It is, but, and the concern is the valuation. This is what happens to stocks that people deem fully or overvalued. But that seems like a bit much, doesn't it?
Well, you sound like my uncle who I had dinner with Saturday night who said the exact same thing. So what I'll tell you is...
And he's a farmer.
A sage.
No, I'm just kidding.
No, he was a Wall Street pro for 50 years.
No, I'm just joking.
But no, listen, you're correct. And I think that's what happens when markets are tense. And we have a very, very tense market. Stock's down 20% or $200 billion from its peak, which is kind of an awe-inspiring number. But you're right. People are a little bit nervous. I think the guidance that they give, and they don't give long-range guidance, they give very short guidance. Amazon's not one who guides 2 or 3 years in advance. And I think they were loath to go out on a limb here and say, all things are perfect. I don't think that made sense to them. I also think my money's on that company and on the big tech companies who are really defining what's going on in this marketplace. Look at how much Red Hat just got acquired for because they want to compete with Amazon Web Services. Does that mean Amazon Web Services is worth 30% more than we thought it was worth 2 days ago?
Well, that's exactly right. And when you start zeroing in on where the growth is, part of the growth stories in this economy is cloud computing.
Absolutely.
And that's what you've got going on this morning. IBM acquiring software and services company Red Hat for $33 billion. Huge premium. Stock is up 50%. It's part of this effort to boost the cloud computing services, which Oracle co-founder Larry Ellison told us about last week. He emphasized the importance of cloud technology in the future.
I think cloud computing is going to change. All these data centers that people have been building are going to gradually wither away, and we're going to have a small number of these huge cloud networks. And because every other network looks like that. People don't generate their own electricity. People don't have wells for their own water. Okay, in a few cases they do, but in the most case we use the network to buy electricity, the network to buy water. We're going to use the network to buy computing and business applications and information. It's going to be on a handful of clouds, and most of the data is going to be in an Oracle database.
So Mark, we know that cloud computing is one of the growth spots. You just said something interesting about IPOs. A lot of these companies that are wanting to go public are either pulling back, lowering the pricing, the one broke price. Does that tell you anything about where growth is or isn't right now? What's behind this IPO issue?
Yeah, I don't think it tells me there's any big fear that the best and biggest can't go public. What it tells me is the ability for, I won't say any company, but the companies we've seen to price at these kind of extraordinary premiums and trade it up as much as they have has been tempered.
So they stopped because of market conditions.
That's market conditions, and just because paying the kind of premiums and paying the kind of multiples, I think, and that had worked, like you said, that had worked for a very long time. We saw every single cloud computing software company that we took public was up 50, 70, 90%. That's going to slow down. That's fine. We need a little bit of that tempering. I think the greatest, and we've seen headlines like Lyft and Uber and all of those that may test 2019 IPO markets, that's not going to slow that down. It's going to make other companies think about what's the proper valuation. It'll make banks recede a little bit on that frothiness, and I think that's okay.
So I think it's interesting you said that you think that we've seen the highs and the lows this year. What makes you think that we've seen the lows, and what should people be doing with their money right now? Where would you like to put it to work?
Well, we've had a couple of corrections like this back in the spring. If you look at your charts from February and a couple months later, we had these kind of pullbacks that found a level, and I think we're getting close to that. We've tested the lows of this cycle, hopefully going into the election. I think people are going to look at what they've owned year to date and surmise in the last few weeks they've been selling. I still think the growth of the market is in tech, and you're seeing the kind of premium that IBM paid to acquire Red Hat. The shareholders of that company, who obviously are going to garner a huge premium today, making big investments in tech. And I think you're going to reanalyze some of those companies who are down 20, 30, 40. The number of companies in tech correction land are very, very high. And I think people are going to take stock of that and look, there's still lots of capital on the sideline. There's tons of money out there for the M&A market. And now you have a 20 to 50% off sell on a lot of tech companies.